Hi, Mr. Alt. Hope you're doing well. As discussed, I've put some slides here to discuss the current situation and why I believe gold could surge to levels beyond $30,000. There's a lot of discussions about tariffs these days, obviously, but tariffs are just the beginning. And I want to discuss what the Trump administration is likely to do next and the impact on gold price. First, a few observations. President Trump's vision to reindustrialize America definitely has merit. I doubt very much that America would reindustrialize with low cost labor to compete with Vietnam. It would be much more likely to unleash a new reality driven by robotics and AI, which are primed to spark a new era of innovation. But the economic policies being implemented are highly risky. Regardless of their ultimate outcome, gold is likely to benefit significantly. President Trump's policies are outlandish, but they are not hectic or chaotic. They are part of a well established strategy. I will bring into focus two underappreciated documents. A level such as 30,000 is not just a flashy headline. I'll remind you that from 1999 to 2008, oil went from $12 to $140, which represents an 11-fold increase. Moreover, so much liquidity has been injected in the system since 2008 that all bull cycles are turning into financial tsunamis. We can think of Bitcoin, the Mag 7, the S&P, even real estate. A bubble doesn't bounce, it bursts. And now the bubble of everything will rotate into the most depressed assets. Tariffs are making headlines. I will discuss what policies are to be expected next and the potential economic slowdown. I will be focusing on Project 2025 and a paper from Stephen Myron, who is now the chairman of President Trump's Council of Economic Advisors. This paper seems to have become the blueprint of the Trump's economic policies. I will also review why gold stocks remain undervalued in the face of a rapidly rising gold price and why I think this will change. Lastly, I will focus only on market-related economics, but don't underestimate the impact of the current geopolitical reshuffle, including the likelihood of Chinese retaliations to these attacks. But first, let's review the primary drivers of the gold price. Gold tends to move upward when the US dollar moves downward, and gold tends to move upward when real rates move downward. Obviously, those are not perfect correlations, but it is easy to find periods where the inverse correlation is undeniable. Now, a quick review of real rates. Real rates are simply interest rates minus inflation. So for real rates to go down, which is good for gold, either rates need to come off or inflation needs to go up, or both. Why is that? To own gold generally doesn't make much sense. It doesn't pay interest, and it costs money to stockpile. As long as real rates are positive, it is better to hold bonds, where you can create value passively. The interest received is higher than the erosion of value caused by inflation. Gold can perform well also when real rates are still positive, but going down, as gold becomes de facto cheaper. However, when real rates are negative, then owning bonds simply destroys value. The interest received is less than the erosion caused by the inflation. Inversely, gold then becomes the instrument by which value can be created passively. When real rates are negative, borrowing costs are lower than inflation, so it becomes possible to borrow to buy gold, which keeps its value with inflation, and that way create value passively. As the bond market is substantially larger than the gold market, gold can become explosive. I believe we will soon enter a period of prolonged negative real rates. Gold and gold stocks were acting very well at the beginning of COVID when real rates turned negative. But many were surprised that gold did not perform better during the period of inflation that followed COVID. This is because the Federal Reserve increased rates at a faster pace than inflation. The Trump administration is deploying policies that are inflationary. Obviously, tariffs, where supply chain disruptions and the tariffs themselves create higher prices. Immigration, obviously, labor shortages will increase wages. Tax cuts, which lead to higher deficits, and also open policies of a weaker US dollar, which will also make imports more expensive. As you will see, the Trump administration is also looking to deploy tools to lower rates. If deployed, those tools will either put pressure on yields or add to inflationary pressure, lowering real rates either way. The Trump administration is also looking to deploy tools to directly weaken the US dollar. All three key variables, US dollar, rates, and inflation, are now and will be increasingly moving in a direction favorable to gold, in addition of demand coming from central banks. Many are hoping that tariffs are being used as a threat for negotiations. While partly true, they are an explicit economic policy of the Marron paper, and they will never be reversed in full. I will here discuss three forces that will lead to lower real rates, i.e. either by lowering rates or by pushing inflation higher, or a mix of the two. Number one, Project 25, especially Chapter 24. Number two, the economic policies described in the Marron paper, which include draconian tools to lower yields and weaken the US dollar. And lastly, I'll discuss the potential economic slowdown. Before I get there, negative real rates are not that rare, and while gold generally does well during such period, it never reacted in the way I'm describing here. Why is that? Periods of negative real rates typically coincide with periods of hardship or crisis. During this period, capital experience a flight to safety. Gold generally benefits from such a flight to safety, but the absolute safety asset has always been the US dollar due to its size, liquidity, and legal structure. As gold and the US dollar are inversely correlated, this tends to curb most gold rallies. This time around, the US is instating crisis conditions while devaluing the dollar. As the US enters a period of negative real rates, the world will have very few alternatives. The self-induced crisis financial conditions may not spread to other countries. This would unwind the American exceptionalism trade simultaneously with the reversal of the bubble of everything. To that effect, since the beginning of 2025, when equity markets are selling off, the US dollar is no longer strengthening. We can also observe that during equity market sell-offs, bond yields are moving higher. Those are major developments in financial markets and previously unthinkable. Such unusual market reactions will probably force the Trump administration to act on the initiatives described in this presentation. If the administration does implement those initiatives, but investors choose to take the opportunity to liquidate their US bonds, the policies could fail to lower yields and instead weaken the US dollar even more, which is the most bullish scenario for gold. Before discussing Project 2025, I need to briefly go over the financial crisis of 2008, which had lasting implications. Before 2008, the Fed conducted open market transactions to impact the Fed's fund rate, which is the rate at which the banks charge each other. And therefore, this impacted yields. But so much liquidity was created in 2008 and shortly after that this approach was no longer practical, as those same open market transactions wouldn't have much of an impact. The Fed had to find a new way to impact yields. So as part of the Emergency Economic Stabilization Act of 2008, the Fed was allowed to pay interest on bank reserves held at the Fed. Those are simply the bank's checking accounts at the Fed. In this way, the Fed was able to keep inflation stable even as it was creating a massive amount of money to prevent a banking collapse. Simply put, if Bank of America, for example, is getting paid 5% by the Fed for the money in its checking account, it will not lend this money to someone for a mortgage at only 4% while also assuming a credit risk. It will simply keep the money at the Fed. The money created on the Fed's balance sheet since 2008 is staggering. The Fed's balance sheet before 2008 was below 1 trillion. It peaked above 9 trillion and now stands at nearly 7 trillion. Bank reserves represent about half of this amount, or approximately 3 trillion. While President Trump denied any knowledge of Project 2025, in his first week in office, 36 executive orders out of a total of 53, or nearly 70%, were recommendations of Project 2025. Now, in reference to the payment of interest on bank reserves, Project 2025, especially Chapter 24, reads as follows. This amounts to a transfer to Wall Street at the expense of the American public. The Federal Reserve should immediately end this practice and stop paying interest so that banks instead lend the money. If enacted by Congress, this policy would open the floodgates of the liquidity created since 2008, which would enter the real economy and reverse the reason why the expansion of the money supply of 2008 did not lead to inflation. While this could be inflationary, the question remains what banks would actually do with the capital. If economic uncertainty prevails, banks are unlikely to increase lending and more likely to buy bonds, which would not do much to help the economy other than help lower yields further. Either way, enacting this policy will be good for gold, as it will both lower yields and push up inflation. In the end, the relative movement of each variable doesn't matter, i.e., if there is no inflation, it will be because the economy is very weak, in which case yields will be even lower. It is the real rates that matter. To put things into perspective, the Troubled Asset Relief Program of TARP, TARP of 2008, was 700 billion. It was later reduced to less than 500 billion. The American Recovery and Reinvestment Act of 2009 was 831 billion over 10 years. The Coronavirus Aid Relief and Economic Security Act of 2020 was 2.2 trillion. The American Rescue Plan Act of 2021 was 1.9 trillion. So 3 trillion is massive. It compares to the COVID stimulus, which ultimately created 50 trillion of household wealth, which is actually more than the entire debt of the United States in only 5 years. Furthermore, this is likely to be combined with tax cuts, which are now necessary to offset tariffs. Quickly, it is a fact that American taxpayers should not have to pay interest to the banks. It is estimated that US taxpayers are paying about 200 billion to banks every year. There's a better way. The Fed could simply reinstate the bank's required reserve ratio, forcing the banks to keep a certain percentage of their assets at the Fed. This is exactly how the system used to work. It would be easy to calculate the current ratio of bank reserves to deposits and set that same ratio as the new required reserve ratio. But Project 2025 doesn't mention this. It advocates for this money to enter the real economy. It wouldn't be surprising that this is what President Trump has in mind when he talks about a new golden age of economic growth. Now moving to Mr. Marin's paper. As mentioned earlier, Stephen Marin is the chairman of President Trump's Council of Economic Advisors. He published a paper titled A User's Guide to Restructuring the Global Trading System, which seems to have become the blueprint of Trump's economic policies. I should say, just like President Trump denies the influence of Project 2025, Stephen Marin denies that his paper is driving the administration's policies. Nevertheless, the initial recommendations of the paper are already being implemented. Furthermore, as the economy suffers from the initial economic policies, the administrations will seek drastic tools to support the economy. The tools described in his paper are sure to be put on the table. And the real story here isn't just the policies of the paper. It is the administration's mindset and how comfortable it is floating such radical ideas. I'd also note that Scott Bessent has described himself as a gold bug because he believed that the US needed to undergo a period of economic adjustments that would favor gold. Now that he serves as the Treasury Secretary, it is no surprise that he supports the kind of policies he has long believed necessary. The Marin paper advocates for the following policies: tariffs, dollar devaluation, and using the Fed to do further quantitative easing to be used to lower yields and also to buy foreign currencies to devalue the US dollar. On tariffs, Stephen Marin sees the optimal tariff level at 20%, which should be applied gradually and well telegraphed to minimize supply disruptions, which explains the administration's off and on narrative. The tariffs announced on Liberation Day are above this recommended level, which indicates the administration's intention to negotiate lower tariffs in exchange for international concessions aimed at weakening the US dollar. Marin makes the case that to avoid tariff retaliations, the administration should link tariffs to the defense umbrella, which we have also observed in the narrative. As per President Trump's narrative, Marin argues that the foreign countries ultimately pay for the tariffs. Two dynamics are really at play here. First, the tariffs lead to a stronger US dollar, as consumers need to buy the currency of the country where a product is manufactured, which offsets the tariff itself. But Marin also argues for policies to weaken the dollar, which nullify this impact. In a recent interview on CNBC, Marin said, "Those countries can't sell those products to anyone else, so they will have no choice but to eat the cost of the tariffs." But then I'll ask, what's the point if the purpose of the tariffs is to remanufacture America? Moreover, any company selling to Walmart, for example, knows very well that the margins are already laser thin. I conclude that the tariffs will be inflationary and will slow down the economy as they are being implemented before tax cuts or deregulations. On the US dollar devaluation, Stephen Marin proposes a Mar-a-Lago Accord, a reference to the Plaza Accord of 1985, which was meant to weaken the US dollar. He proposes negotiating tariff reductions in exchange for measures by other countries to strengthen their currencies. He proposes to force foreign countries to increase duration of bonds also, i.e. sell short-term bonds and buy long-term bonds, or simply impose a longer maturity on bonds already held by foreign countries. This would force foreign investors to carry more risk. Marin writes, "In this world, both the dollar and long yield can come down together instead of moving in an opposite direction." I can't imagine a better scenario for gold. Marin suggests to use the International Emergency Economic Power Act of 1977 to impose a user fee on the foreign holders of US Treasury, i.e. if a country owns a bond paying 5%, the US would pay only 4% and keep 1% as a user fee. Marin writes, some bondholders may accuse the United States of defaulting on its debt. Yes, they surely would. To mitigate the impact, Myron suggests to start slow, but foreign holders would rapidly price further increases in the user fee. Myron also suggests to use the Gold Reserve Act of 1934, which allows the US to sell some gold to buy other currencies and therefore weaken the US dollar. And he's also suggesting to force the Fed to do more quantitative easing and use the newly created dollars to buy foreign currencies. Jerome Powell, the current chair of the Fed, is unlikely to play along. This could be implemented by his successor, a Trump nominee confirmed by the Senate, after May 2026. The proposals described in Myron's paper are nothing short of draconian. They would define a new world order with enormous implications. But above all, they are extremely risky, and any non-American assets, and especially gold, are likely to benefit greatly. For more information about the Myron paper, I suggest looking at the work done by Richard Duncan, in my view, one of the most insightful economic minds. I also note that May 2026 will be a moment of extraordinary significance. Should President Trump succeed in appointing a loyalist as chair of the Federal Reserve, it would mark one of the most consequential developments in modern history, with the potential to trigger dramatic surge in gold prices. The process is as follows. The president nominates the Fed chair, who must first be approved by the Senate Banking, Housing, and Urban Affairs Committee, and then confirmed by a majority vote in the Senate. While some Republican senators may be inclined to break ranks, it's worth noting that the Banking Committee is currently chaired by Senator Tim Scott, a known Trump loyalist. For some time, several initiatives have been put in place to reduce the reliance on the US dollar for international trades, and I think this could cause an acceleration of the de-dollarization. We can think of the cross-border interbank payment system of 2015, the instrument in support of trade exchanges of 2019, the BRICS contingent reserve arrangement, and there's been several bilateral currency swap agreements between different countries. But so far, all of these alternatives to the US dollar have been suffocating in an environment that was generally driven by a shortage of US dollars. As the current administration takes aggressive steps to devalue the US dollar, it is very possible that those de-dollarization initiatives greatly amplify the intended impact of the policies being implemented. In other words, the administration could lose control of the weakening of the dollar. Moreover, as the administration continues to deploy a tariff-based strategy, new trade agreements that exclude the US should probably be expected. Now on the potential economic slowdown, which would obviously lower yields. The GDP is calculated by adding the consumer, C, government expenditures, G, investments, I, and the trades, calculated by the exports minus the imports. Starting from the right side of this equation, a trade war is bad news for trade, period. Now moving to the investments, tariffs are an incentive for companies to invest in the United States and less abroad. But policy volatility and economic uncertainty erode confidence, which leads to lesser investments. Now, importantly, on government spending, economic growth is driven by credit growth. This has been the case for several decades now. And the credit did burst in 2008. Since then, economies globally have been sick, and government spending has become the life support. It is far from ideal, but it is the reality, and government spending now makes up 23% of the US GDP, and that includes the federal spending only. Without this government spending, the economy would have fallen into another Great Depression after both 2008 and COVID. To cut government spending to fix the economy is equivalent to stopping chemotherapy to cure a cancer patient. Needless to say, waste, fraud, and abuse, as it's being characterized, should definitely be identified, but reallocated into government investments, not to support a deficit reduction. A country cannot shrink to greatness. Deficit reduction must come from economic growth and lower the deficit to GDP ratio. It is possible that deregulation and lower yields will eventually be sufficient to offset the spending cuts, but it is a very risky proposition, and deregulation and lower yields should have come first. And lastly, on the consumer, just as important, the American consumer has been an economic miracle for a very long time, mainly driven by globalization, which led to lower inflation and lower yields, which in turn were used to refinance mortgages and gave consumers credit to spend. This period was followed by a period of massive wealth creation, triggered by the COVID stimulus and the following real estate boom and stock market rally. The household wealth created in the 5 years following COVID is larger than the entire debt of the United States. There is now a real risk that this miracle has come to an end, triggered by a weaker equity market and lower government spending, and also higher yields. Overall, it is possible that lower taxes and deregulation are able to offset all of the above, but it is unlikely, especially that all of the policies that can slow down the economy seem to be implemented first. Also, lower taxes cause larger deficits, and larger deficits are a positive driver for the gold price. When the reserve currency is doing well, there's no need to own gold. Gold was deeply out of favor during the Clinton years, where the US last experienced a period of budget surplus. Today, most currencies are not doing well, and policy decisions suggest a waning commitment to preserving the US dollar as the primary reserve currency. As the world and central banks refocus their attention to the value of hard assets, a look at history can give us an idea of where gold could go. The next slide shows a chart of the historical value of gold reserves as a percentage of government debt. Parallels can be drawn with past points in history to establish levels where the world would regain confidence in the US dollar. Now, making sense of this chart. When the share price of a company is acting well, its share price is generally a reflection of the company's future earnings. When a company's stock price is in free fall, however, it is common for investors to look at the book value or the liquidation value of the company's assets to establish the stock's floor price. The value of the US gold reserves is the book value of the US dollar. A return to the level reached during the last inflationary period would bring gold back to $24,000 an ounce. But the rule of law was never shaken during that period. A return to the point where the US dollar was established as the primary reserve currency would bring gold to even higher levels. Pierre Lassonde, one of the world's most famous gold investors and founder of Franco-Nevada, predicts the Dow to gold ratio will, once again, fall to 1 to 1. The current Dow level is around 40,000, and the current gold price is around 3,000. With the Fed's current mandate, it would be unthinkable to see the Dow index experience a drop similar to the Great Depression. A sharp rise in gold price is a much more likely path forward. But what if tax cuts are sufficient to avoid a recession? In such event, it will be because tax cuts will have been massive, which would drastically increase the deficits and the debt level. Over the long run, gold tends to follow the total debt level, as you can see on the chart. The tariffs announced on Liberation Day are an enormous tax increase, 6 trillion over 10 years. To offset this tax increase, the tax cuts would need to be larger than the tariffs themselves, since wealthier individuals inevitably spend only a portion of the tax cuts. The different COVID stimulus were saved at a rate of about 35%, and therefore about 65% were spent. Applying this 35% saving rate, the required tax cuts to offset the tariffs are approximately 10 trillion over 10 years, or 1 trillion annually. The above does not even include tax cuts required to offset the decline in government spending, investments, and consumer spending. Given that the US collects approximately 5 trillion annually in tax revenues and pays nearly 1 trillion in interest alone, such tax cuts may prove fiscally unfeasible, and therefore a recession is probably unavoidable with such tariffs level unless there's a change in policy. Why are gold stocks so cheap? It is not unusual for the equity market not to believe the initial rise in a commodity. A prime example is in the late 90s, the oil stocks were extremely cheap on a cash flow basis or NAV basis, yet oil was on the eve of its famous rally to 140. At the time, the argument was, well, oil is not sustainable at $12. We have learned in recent years that the world cannot function with oil above $10, so the market was not paying for those cash flow. Ultimately, oil went to $140. Similarly, today's gold stocks do not reflect the current cash flow generated by the mining companies. But as you will see, the market is not incoherent. The chart to the right represents the real rates in blue and the gold price in yellow. On the left-hand side of the chart, gold and real rates are negatively correlated as per a normal market. This is the same chart I presented earlier. Starting in 2020, it is clear that gold and real rates have developed a positive correlation, i.e., gold should have been going down or stable at best, yet gold has been moving upward. The reason is central banks globally have been accumulating gold, most likely in anticipation of the dynamics we're now facing. Therefore, as gold should not have been going up, the market hasn't been incoherent by not chasing gold stocks. If gold should not be where it is, why would the market pay for those cash flow if they're not sustainable? Since the general equity market was performing very well, there was no incentive for investors to challenge this concept, until now. But as real rates finally fall and turn negative, the Western investors will join the central banks in buying gold, which will cause gold to accelerate to the upside. Western investors will also buy gold equities, as now gold deserves to be moving higher. Real rates went negative for a brief period during COVID, and gold stocks catapulted until the Fed started raising rates. Gold equities will experience a catch-up in valuation to the current gold price, just as the oil stocks did in the early to mid-2000s. I believe buying gold stocks represent a fantastic opportunity, and many activity is already picking up. I especially expect junior gold companies to be particularly rewarding for two main reasons. First, they have yet to appreciate in value, and two, the major producers are already realizing enormous profits, yet they need to replenish their gold reserves in the ground. Taken as a group, the major producers have depleted about a third of their reserves in the last 15 years. At this stage, it is far cheaper for them to acquire companies that have defined resources rather than exploring for gold themselves. Thank you very much.